let's kickstart with the first conversation of the day, and that has to do with passive investing. Join me to talk about this is Santosh Navlani, who is the Chief Operating Officer at ET Money. Thank you so much, Santosh, as always, for taking the time, and good evening to you. Would you say that it's fair that most people who talk about passive investing use it as a reference to investing in the Nifty 50 or in the most popular gauge of the equity markets? And it's interesting that we're talking about this because a lot of people are familiar now with passive investing. I don't think that was the case 5 years back. So we're making progress. But would you say that most people look at passive investing and Nifty 50 in the same breath?
Alex, yeah, you're absolutely right. I think most people, when we reference performance of markets, we tend to reference always to Nifty 50 or benchmark as Sensex. And hence, when we talk about passive funds as well, we are forced to reference it to Nifty 50 Next 50 or maybe at max Sensex all the time. But the truth is today with so much awareness about passive or active funds failing to beat the respective benchmarks, the talk about passive is actually becoming more mainstream, and even the products are becoming mainstream. So if you look at today's suite of products available, it is no more confined to the market's gauge, which is Nifty 50 in that sense, as the only option available. There are multiple options available across market segments, as well as combining multiple segments into one as a passive fund. And I think there is so much excitement around it that it makes sense to consider some of those funds as well.
So let's break this up into categories. I think the easiest way to do this would be to break it up in terms of market capitalization, right? And Santosh, I must point out at the start that tomorrow I will also be talking to you about a smart beta and a slightly different approach to investing in passive. But today, let's focus on these passive strategies. So if we break it up into the market capitalizations, let's first talk about large cap, and then we'll talk about mid, small, and multi cap as well. But in the large cap space, is it only Nifty 50 that you consider? How do you go about it?
Alex, in the large cap space, there are primarily options which are Nifty 50, Next 50, Nifty 100, BSE Sensex, and BSE Sensex Next 50. The primarily five passive broad-based market capitalization-based indices in the market today, and all these have almost similar performance ranges if you look at it. But when you really want to decide which one makes more sense for someone, one needs to look at returns, risk by returns, returns by risk, and even what is kind of volatility of returns within these indices. And the more deeper you go into, you will realize that there is not much difference between returns that you can generate by putting money in Nifty 50 or Nifty 100. They are very, very correlated. And the reason for that, because Nifty 100 primarily is a combination of Nifty 50 and Next 50 as a set of stocks. But because of market capitalization weightage, what happens is Nifty 100 ends up giving you almost 75% or thereabouts as Nifty 50 exposure. Only about 25% goes to Nifty Next 50. So even if in the long run, if you look at it, some of the times Nifty Next 50 has given far better returns compared to Nifty 50, but Nifty 100 tends to be giving a replication of what Nifty 50 would give for you. So if you were comparing returns between Nifty 50 and Nifty 100, it makes sense to stick around with Nifty 50 and not unnecessarily take the extra cost that you might be having, because expense ratio of Nifty 100 may be higher, and even some of the times impact cost may be a bit higher. So stick to Nifty 50 in that case. But Nifty Next 50 is pretty interesting. If you really analyze the performance of that, you would see that some of the years the performance actually is far, far better than Nifty 50. And the bull run, the returns of Nifty Next 50 as an index typically are equal or higher or thereabouts, like a mid-cap index. So it makes sense to look at Nifty Next 50 as a very good tactical positioning for your portfolio whenever there is a rally in the marketplace. And it gives you a very good risk-adjusted returns without having the downside that a small cap or mid cap can typically give you. So between Nifty 50 and Nifty Next 50, you can actually create a good portfolio for yourself depending on risk profile.
Okay. Why don't you I guess we'll need to delve a little deeper into this. So maybe if you talk about a couple of stocks, it would make a lot of sense, right? You mentioned that if you have the Nifty 100 as opposed to Nifty 50 held separately and Nifty Next 50 held separately. If you have the Nifty 100 as a whole and you put 100 rupees, say, only 25 rupees is going towards the Nifty Next 50. And that's because of companies like Reliance Industries, Tata Consultancy Services, etc., which hog all of that amount of money, right? Essentially.
Yeah. Yes, because if I were to look at the Nifty 50 components, Alex, you basically would say not a large cap. You look at giant cap, like they are really big companies with Reliance, HDFC Bank, HDFC Limited, Infosys, TCS. I can go on, and these companies are so big that if Nifty 50 were to look at as a weighted Nifty 100, these actually hog almost entire index for yourself. So by definition, when 75% of the money is going in Nifty 50, even if you're putting in Nifty 100 your money in, you would realize that the upside downside is almost equal to Nifty 50. So you're not getting a benefit of broader diversification that you would expect by putting your money in Nifty 100.
And to extend that point further, one would argue that the Nifty Next 50 is a group of stocks that is on the cusp of becoming large, very large, right? And so the potential for these is more, but at the same time, they're not necessarily mid-cap because they are within that ambit of the large cap. So does that explain the outperformance that has happened? And of course, I'm not trying to suggest that will always take place, but the potential for outperformance is there, right?
Of course. So if you look at the long-term performance of Nifty Next 50, Alex, you would see they are very similar at times with Nifty 50. But there are periods where Nifty Next 50 almost gives you mid-cap kind of returns. And that's to do with the kind of companies which are part of Nifty Next 50 index. So basically, Nifty Next 50 comprises of stocks which are most liquid stocks after Nifty 50 stocks. On the NSE exchange. And by definition, these are the companies which are supposed to be large, are having larger earnings visibility, are probably better marketable brands, and a lot of interesting things around their business models as well. So they are companies which have broken out of mid-cap range and are almost moving towards stable large-cap businesses, but are still not yet there, which can be such that you are counting them as a part of Nifty 50. So Nifty Next 50 gives you a very good balance of a mid-cap and a large-cap kind of exposure. So I would not really look at Nifty Next 50 as a pure large-cap, because if you look at the correlation of performance between mid-cap 150 index and Nifty Next 50 index, there'll be almost like a 95% correlation. So typically that happens when there is a broad-based rally in the marketplace. That's where these kind of stocks do really well. Hence, having a Nifty Next 50 index fund separately in your portfolio, depending on your risk appetite, allocating 20% of your portfolio there, maybe 30%. If you do 20%, that means you're almost buying Nifty 100. But the moment you do 30-40% of your large cap allocation towards Nifty Next 50, your portfolio may be subject to more volatility. But if you're a long-term investor, you might be able to beat the returns which you can earn by putting money in Nifty 100.
That you're talking about allocation, you're talking about a strategy of putting a portfolio together, because that's essentially when you're talking about an equity portfolio, the suggestion generally is to have a core and a satellite allocation, right? And in that satellite allocation, you would necessarily be willing to take a little bit more risk for the potential of higher return. To that end, a lot of people choose to have an active kind of a strategy. But do you think that a passive strategy is also something that you can consider? And what I'm leading you to, Santosh, is the broader gauges. Does it make sense to allocate a satellite allocation towards these broader gauges? Let's talk about the multi-cap indices.
Sure. So, Alex, to answer the previous question, I would look at core and satellite as something. Core is your long-term portfolio, which you will not tinker around with too much. It's a buy and hold, continuously doing SIP in that kind of portfolio, rebalancing whenever there is a need to do it. But these are basically your core allocation of equity, debt, gold kind of portfolio. And when we talk about equity, it's diversified equity there. Satellite will typically be about as an individual investor, I would take a bet on banking index. I might take a bet on momentum as a play in the marketplace, or I would probably build some smart beta strategies in my portfolio. So that becomes satellite, which is, I would spend about 15-20% of my portfolio allocation there and time there and try to create some alpha. But I would not look at broad-based indices like mid-cap 150 index or small-cap 250 index as a satellite. Coming to second point of yours, how do we look at multi-cap indices? There are broadly two ways to play, and both of them are pretty new in the marketplace. So till recently, we never had these two index funds available in the marketplace. So it's quite encouraging to see this innovation coming from fund houses. So we have three options today. One is a Nifty 500 index fund, which is available by Motilal Oswal. There is another one which is on BSE 500 ETF available by ICICI Prudential. And there is another one which is basically replicating the Nifty 250 index, which is large and mid-cap index as popularly called, by Edelweiss Large and Mid-Cap Index Fund. So if you look at the performance of Nifty 100 and Edelweiss and Nifty 250 index, you typically would see that the returns of Nifty 250 index are actually far more consistent, less volatile, and similar to Nifty 500 or higher at times than the what you can get by Nifty 500 because there is more volatility there. And simply because what happens is in Nifty 500, your 10 to 13% of component ends up getting exposed to small cap stocks, which is part of small cap 250 index. And in the Nifty 250 index, you basically get confined to top 100 stocks and then mid cap 150 stocks, which combines put together makes Nifty 250. So the lack of exposure towards small cap typically would make an investor feel that he or she would not make enough money, and hence a small cap exposure is desirable separately. But data doesn't prove like that. If you look at the long-term performances, you would be surprised that Nifty 250 index fund, despite